Hello Sector Watchers, welcome to the 25th episode of Sector Spotlight for Tuesday the 7th of April 2020, which I'm recording on Monday the 6th. This is your weekly update on sector rotation and anything remotely connected to relative strength and or rotational analysis. My name is Julius de Kempenaer and I'm your host for today's show, based in Amsterdam, the Netherlands. Ladies and gentlemen, this is Sector Spotlight. So what's the plan for today? As usual, we'll have a quick look at what happened in the various asset classes last week. And then because it is the first Tuesday of the month, we'll have a thorough look at the various sectors, and we'll be doing that using the completed monthly bars of the month of March. That will take up some time, and then of course we'll have a break. After the break, I will take a look at a question that came in, and the question basically is, can you use RRGs to monitor mutual funds? The short answer is yes, but we'll dive into that later on. So right now let's get started with the overview of asset classes. Let's start with a quick overview of what happened in the various asset classes last week. Here's the perf chart. Relatively quiet week, I should say. No double-digit moves, although real estate came pretty close with a minus 9.85, followed by US stocks, almost 6%, and then we have high yield, which came down almost 5, real estate a little bit over 3, corporate bonds minus 2, and then we've got the pluses for commodities. Maybe that's going the right way. The RRG we'll see later doesn't show much good. And this is treasuries, no surprise, and the US dollar strengthened again last week. If we look at the RRG that belongs to this set of asset classes, we still see a very clear risk-off rotation with corporate bonds, US dollar and US treasuries inside the leading quadrant and still powering further into that leading quadrant. And stocks, ITOT, VNQ and commodities inside lagging. And except for commodities, which seems to be leveling off a little bit, real estate and commodity and stocks are still moving further into the lagging quadrant. High yield is with it's positioned right here with a very short tail, stable but going in the right direction. So the general message from the asset class RRG is still risk off. And if we move to the sectors for the performance of last week, then we'll have the perf chart here, which essentially shows us that all sectors were in the negative except for one, and that was energy, which maybe is a sector you wouldn't expect to be a positive when the S&P 500 is down around 5%. But on the other hand, I also wouldn't expect utilities to go down 10% in a week for the S&P 500. So we've got utilities over 10%, real estate was very bad, financials not very strong, discretionary minus 7.7 around that, materials, technology wasn't able to keep up this week, so we'll see how that goes on the RRG and the monthly chart. Industrials weak in line with the market. Here's the S&P 500. We got communication services, which is holding up pretty good. Healthcare continues to do well. And then we have staples only down 40 basis points. And as I said, energy up 4%. If we make that relative, then we see that the S&P is right here. Everything to the right from industrials onward, technology, etc. has been underperforming the S&P 500. And obviously energy is the big outlier, the big outperformer for this week. If we quickly plot that on an RRG, then we see basically a continuation of the rotational patterns that we've seen over the last few weeks, which means that we have the defensive stuff inside the leading quadrant with staples still doing very well, heading further into it. Utilities, because of that week last week, last week's performance, starting to roll over. We'll have to see how that develops in this week, because otherwise we need to maybe start pay a little bit more attention to utilities, because in a defensive modus we would expect utilities to do well in line with staples. Healthcare continues to perform very good. It's now well inside the leading quadrant and powering higher. And now we have two more. We have communication services. We've talked about this sector a couple of times already. It's very close to the benchmark. It's staying in line with the benchmark. Not a lot of alpha to be gained there. And then we have technology, which is maybe the new defensive sector, as it's holding up really, really well at the right-hand side of the graph. Still above 100 on the momentum line. Rolling over slightly, ever so slightly on the RS ratio, but the tail here is very, very short, and short tails tells us that the sector is stable. It's doing its thing. It's not making massive moves up or down. So technology is, as far as I'm concerned, holding up as one of the better sectors inside the S&P 500. If we go into the lagging quadrant, then obviously there is the energy tail, which is still sort of disconnected from the rest of the world, rest of the universe, I should say here. And then the tails for financials and industrials are sending a very weak message for these sectors in the weeks to come. And then we have materials, XLB, also with a very small tail like technology, but also like discretionary and communication services, which means that it is a stable trend, in this case a negative stable trend. So materials continues to carry on underperforming the S&P 500. Here is the discretionary sector. I actually wrote a blog about discretionary and discretionary versus staples last week, because usually the gauge staples versus discretionary gives you a pretty good handle about the general direction of the market, because in a, well, maybe quote unquote normal world, discretionary staples are expected to move in opposite directions. Well, they are not doing that right now, at least not the spider funds, which are based on the market cap weighted indexes, which is like XLY and XLP. In the blog that I wrote, I actually looked at the composition of the sectors, and in discretionary, Amazon is a very heavyweight stock. And if you take out the performance of Amazon, the consumer discretionary sector looks quite different. And this article goes into how that one stock is actually holding up an entire sector, and questions whether it might be a better idea to not use XLP, XLY as the gauge, which you see here as are moving in the same directions, but the equal weight variance, which is RCD and RHS, which are the Invesco equal weight sectors. And this blog explains a little bit on the differences and how you may be able to use that gauge, that relationship, to get a handle on the movement of the market as a whole. Anyway, if we quickly go to the monthly charts for the month of March. March is closed. So we have materials, which clearly broke the rising support line, but now also broke, I think we qualify this as a double top. And although we didn't reach the horizontal support level, which is 3350 roughly, we're now rallying here, but this former support level is now expected to act as pretty serious resistance, and that's in the area around 47. And we saw that materials were in the lagging quadrant. So I expect the materials sector to have a hard time getting back above that 47, 47.5 level. If we go to communication services, we see a similar pattern, although not like the nice double top that we saw in materials, but the rising support line has been broken. We tested the horizontal support, which is actually not too old. It's the December low of last year, and we're now crawling back up. This week, this month, it's going to be interesting to see how strong this resistance coming from that trend line will be, because we're actually pushing against it as we speak, basically. If we get back above that trend line, I'm tempted to give communication services the benefit of the doubt and say that this has just been an outlier, because as you can see, the close of last month was actually right inside the channel. So this 1 week of performance, we opened right at it, we dipped lower during the week last week, and right now we're like trying to get back above that former support level, now resistance. If that works, then we're building a nice little base here against that trend line, and that could be good for the communication services sector going forward. If we look at energy, that's actually a seriously weak sector. A couple of months ago, actually already, this one was breaking out of an already declining trend channel, which is a super negative that usually causes an acceleration, which it actually did in the month of March. But we've broken roughly every support level under the sun, horizontal support level that is. The last one was around 36, which was important because of the highs in 2000 and 2001. This little, break test in 2005, and then a serious low again in 2009. And we're now underway for a test of, and this is the all-time low for this ticker symbol. It actually started to trade in 1998, and the low that we had was around 20. So keep an eye on this, but the upside is filled with resistance. So, on the RRG, energy shows a very weak rotation. That's not a good signal. And on the price chart here, we see big bars down. We see every support level broken. We're now sort of testing this all-time low. Upside will be very, very difficult for the energy sector. Financials, obviously a very important sector inside the S&P 500. Trend line broken, no surprise there. But here also something that could qualify as a big double top that's been broken. The support level that was tested was coming back from the 2010-2011 highs. We rested at that level, at least for now, but as you can see, the upside will be difficult. So I'm looking for a lot of resistance for the financial sector, for XLF, around that 22 area. If we're able to break it, I doubt it, but if we're able to break it, then the next level is already coming in around 24. So for financials, upside also very, very limited, which is in line with the weak rotation on the RRG. Going to industrials, we see that here as well, not surprisingly, the rising trend line has been broken. It doesn't really qualify as a double top because that last peak here was well above that horizontal level. We broke it, and we're now sort of struggling with this 2018 low. The close of the monthly bar was actually above that level, and we're now like struggling to stay above that level. So I'm gonna take a look this week, this month, coming weeks, to see if that level, which is around 58.50, ultimately maybe even this level here around 52, which is the, that overshot bar here, could be a support level. It looks as if this sector is stabilizing. It's still a risk-off sector, that's very clear. But I'm going to keep an eye on this 57.50 level for industrials to see if that holds and if we can come up with any material upside out of this level. The technology sector actually makes for a very interesting chart, because it did test support. It was a support that was actually formed in May of 2019. It didn't even go down to the 2018 lows that we saw in a lot of previous sectors. But it also didn't break that rising trend line. As a matter of fact, I think that that trend line here is now getting more and more validity, because we have 1, 2, 3, maybe, you know, if you draw it with a thick adding, 4, and maybe this is the 5th touch point. So we got a lot of touch points in that area, which makes it more reliable. And we actually jumped out of that low to seriously higher levels, because we put in a low around below 70 actually, and opening of this month already around 80. So technology is holding up very well, as we've seen on the RRG, where the tail of the technology sector is still way to the right inside the leading quadrant, and this monthly chart seems to confirm that positive rotation for the technology sector going forward. Consumer staples, traditionally a defensive sector, as you all know, and we can see that here, because if we look at the bar of last month, we see that the low actually came in around 47.50, but it recovered quite rapidly back into that former rising channel, and we're still there. We're now actually trying to conquer back above that former support, now resistance area. That trend line here, that trend channel here seems to be intact. You know, if this is intra-month, one big drop down and then quickly rallied above it, I'm happy to actually ignore such a move on a monthly bar. And you know, as long as we stay, let's say, above 52.50 this month, I'm tempted to call this trend channel intact, with the consumer staples sector continuing its upward trend. The big difference is that when it was rising inside this channel here, the staples sector was underperforming the S&P 500. Right now, we're still in that channel, but we're outperforming the S&P 500, which is a big, big difference. Real estate got hammered down pretty hard last month. We closed the month of February around, what was it, 35.50, which was still okay, above this former resistance then support level. But during the month of March, we got a big wave down, sliding through support here, sliding through support around 28.40, and it came to rest at support near 25. Bounced off it, back above that 28 level, and still in the middle of that range. So a little bit too early to call this a low, I guess. There's no reference in terms of trend lines that we can look at. So I'm going to watch XLRE as being in a trading range between roughly 28 and 34 on the upside. Let's see how that develops. Probably some big swings ahead of us. Difficult to trade. We'll have to wait and see. This is one of the sectors that we'll have to wait and see how it goes, because it should be defensive. It isn't. It's also not really an offensive sector. So where is it actually? I don't know. Right now on the RRG, it's inside the improving quadrant, but already rolling over without hitting leading. So that all makes me a little bit nervous with a directional call for the real estate sector. It's not a very strong sector, that's for sure. Utilities, with staples, probably the most predominant defensive sectors in the universe. And it's doing a little bit of the same. We had this massive bar down during March, which dipped below 45, but rapidly recovered and actually closed inside its rising trend channel. So if we actually wouldn't look at the bars, but at a line chart with closing prices, you wouldn't even see this dip here. It would still be inside that rising channel. For what we've seen so far last week, the first week of the month of April, we see that we had a little bit of price action below that support line, but it's now already back into that channel, and it looks as if we're trying to put in a new low here, which again, I would say validates this trend line. You see there's a lot of touch points over time with this trend line, and it looks as if we're putting in a new one here. if we see that overshooting to the downside as an outlier, I would say that this trend channel is still intact. And again, just like staples, here utilities were underperforming the S&P 500. Right now they're outperforming the S&P 500. The healthcare sector, something similar. Again, I mean, all these sectors have broken down big time in March. Big time overshoots, but I think it's important to watch the recoveries, because the recoveries from these overshooting markets to the downside can tell us a lot about the strength of the market. And what we see here is that healthcare actually almost came to test a former resistance, now support level just above 70. And let's say that this is a range between 70 and 75. I'd say that is a pretty good support range for the healthcare sector. But we're already back into this trend channel. So again, it looks as if this healthcare sector is coming back in line with what we see on the RRG, where you see the tail of XLV rotating back into the leading quadrant from weakening a couple of weeks ago. And obviously, I mean, I'm not a fundamental analyst. I'm not trying to make any fundamental calls, but I can actually see that healthcare is a sector that people are trying to invest in, because if we get a cure for this virus or a vaccine, then this is the sector where it has to come from. So there's probably going to be a couple of companies inside this space that will do very, very well. For now, it's definitely one of our outperformance going forward. And then finally, the last sector, which is consumer discretionary. Super nice uptrend since 2009, which started really to adhere to that rising support line from 2011 onwards. A lot of touch points, very valid trend line, definitely broken now. We came to sort of, well, we didn't reach the support level, say about 77.50. We did break through and come back that support level around 90, which lines up the high from 2017 and the low from 2018. That seems to be the closest nearby support level right now. We're bouncing off that, and we'll have to see what happens when prices reach that former rising support line again, which will definitely start to act as resistance. It will make life for the discretionary sector quite difficult. And as I already mentioned, it's predominantly one stock, Amazon.com, that's holding up the performance for this sector. If you take that out, the sector looks completely different. So be careful. This is not a defensive sector. This is an offense sector. And with a market that is in risk off mode, this means extra risk to invest in a sector like this. Here's a question from the mailbag. Somebody wrote me an email. Sorry, I can't remember the name. I'm sure I had it, but well, it's either an email or a Twitter message or something else. But a question came in asking if RRGs could be used to track mutual funds. Yes, of course. The price of a mutual fund is the result of the performance of the investments of that fund in the market. So in essence, it's a time series of prices, just like, you know, like a SPY or a sector ETF or a stock price. It's a series of prices over time, and we can actually well, and they are the result of what's happening in the equity market. I wouldn't. Anyway, so the price series of a mutual fund can very well be plotted on an RRG, and you can actually keep an eye on a portfolio of mutual funds through an RRG. And what you the setup is exactly the same. For I don't know too many US mutual funds, but I do know a couple of big names. So like Fidelity, and of course, I had to take some examples from Fidelity because my good friend Dave Keller worked for Fidelity many years, and we had a good relation back then, and I want to keep that going forward. So I'll use some Fidelity funds in this example, but you can actually do it for Invesco, for Wellington, for Vanguard, for State Street, any mutual fund provider, doesn't really matter. As long as you've got the price series and a ticker symbol, you can actually stick it into an RRG. And you will get an RRG that looks like this. And if we quickly browse to the table, then you see that I've just picked completely random a number of Fidelity funds. The Fidelity Trend Fund, Disciplined Equity, Low Price Stocks, New Millennium, Mega Cap Stock Fund. So you got like all these themes and sectors and regions and industries and what have you, where they have a fund for, and you can actually put that in an RRG. And you can see that it just behaves like a normal RRG. They actually rotate. The benchmark here is the S&P 500, but you can make it another benchmark if you like. The interpretation is exactly the same. What actually is quite cool to do is actually bring a few mutual funds that aim, let's say mutual funds in the US large sector, US large cap space. Very likely, most likely, the portfolio managers of these mutual funds will have the S&P 500 as the benchmark. If you plot a number of these funds that have the same benchmark on an RRG against that benchmark, you can actually compare the performance and the quality of the fund manager that's running that fund. Just a thought. Long story short, yes, you can actually plot mutual funds on an RRG. Works very well. Interpretation, setup, exactly the same as for ETFs, sectors, etc. I hope that answers the question. Regular watchers of Sector Spotlight know that I usually have a pair trade idea at the end of each episode, or we look at the outstanding ideas that were launched in previous shows. For this week, however, I'm running out of time, so I owe you a new idea, which I will most likely write up in the blog article. Please stay tuned. Ladies and gentlemen, this was the 25th episode of Sector Spotlight. Thank you for watching. Please don't be a stranger and stay in touch. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Especially during these crazy times, I welcome your feedback, questions and suggestions as input for the show. So if you have anything to say, don't be shy, drop me an email. If you want to stay up to date on sectors and RRGs, please go to the RRG blog at StockCharts.com and subscribe using the link below each article. Please stay safe, and I hope to see you back next week.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.